Welcome to Harvest Financial Advisors Quarterly Update. I'm Marc Henn, CEO and founder, and as fall approaches, the kids are back in school and the pumpkin spice is flowing. It's a perfect time to reflect on the economic and stock market activities from the third quarter of 2025 and share our insights on what lies ahead. Now, a brief FYI, because of scheduling, I am recording this before the quarter end on September 25th. In this video, we're going to dive into current market and economic conditions, monetary policy, give an update on tariff policy, and look at what 2026 may bring. The year 2025 has been characterized by uncertainty, primarily due to ongoing tariff talks. Despite recent weakness in the labor market, employment remains on a firm foundation. Notably, the U.S. real gross domestic product saw growth in the second quarter, underscoring the resilience of the economy amidst external pressures. Global trade tensions have created ripples across various markets, compelling investors to reassess their strategies. For example, international equities did poorly from 2007 through 2024 versus the S&P 500. Yet as trade tensions grew and Europe reassessed its commitment to fiscal and monetary stimulus, an opportunity presented itself. And while some sectors felt the pinch of tariff uncertainty, others found opportunities to innovate and expand, such as technology. Early in the year, concerns about a recession emerged with the onset of tariff discussions. Fortunately, we didn't subscribe to this perspective. Our analysis suggested that tariffs are more of a stumbling block than a roadblock. Likewise, we do not foresee a recession, and as the year progressed, we anticipated a rate cut or two from the Federal Reserve, like we saw on September 17th. We are aware the Fed's monetary policy may shift due to political pressure rather than economic necessity, but are optimistic that accelerated interest rate cuts could provide a shot in the arm for consumer confidence and spending. Now, while many are weary of tariffs, President Trump remains committed to them. Despite the Federal Court of Appeals ruling against the tariffs, we anticipate that the U.S. Supreme Court may overturn this decision due to presidential regulatory authority. This political landscape adds an intricate layer to market dynamics, requiring close attention to policy developments and their potential impact. Now, it's important to note that we don't view the Trump administration as permanently committed to its tariff and immigration policies. Should these policies significantly impact growth, we believe changes could happen swiftly. For instance, earlier this year, after a market retreat, President Trump revised his tariff strategy, showcasing the administration's adaptability in the face of economic challenges. The administration initially stated that companies exporting goods would bear the tariff's costs. However, according to J.P. Morgan, this isn't happening as expected. While some costs have been passed on to consumers, most have not. Instead, businesses are looking to cut expenses, contributing to recent labor market weakness. This strategic cost management highlights the importance of operational efficiency in navigating uncertain terrains. Looking forward to late 2025 and into 2026, we anticipate mild to moderate growth, supported by increasing money supply and spurred on by consumer spending, with interest rate cuts providing a bump as well. While these economic indicators suggest a favorable environment for equity markets, it is hard to overlook the appreciation in the markets these past 3 years. Now, a brief aside about the markets, I've stated before, and it is worth mentioning again, with the current equity run, that sometimes the market gets into a pattern where bad news is good and good news is great. While I do not believe we are fully at this point, the market is trading like it is close to this occasional market axiom. It's important to note that the opposite can take effect as well at some point. Good news is bad and bad news is horrible. Our focus in these situations is to continue to take advantage of upward and downward trends by rebalancing portfolios. Now, back to the economy. The fly in the ointment could be unexpected economic declines from tariffs that could create headwinds, emphasizing the need for diversified investment strategies. While we have seen some initial data on the tariff impact, there is still more to come into next year. Our focus continues to be on utilizing companies that have the wherewithal to navigate these factors and still drive growth. In summary, we looked at current market and economic conditions, monetary policy, an update on tariffs, and what we are monitoring for 2026. If you have any questions, please do not hesitate to contact us. We appreciate your trust and are grateful for your continued support as we navigate these complex economic times together. Thank you.